Hi everybody, today I'm going to update you on the performance of my stocks and unit trust portfolio. I've also added 2 new stocks into my stock portfolio, and I'll talk about these 2 stocks at the same time. This is the stock portfolio as of 8th of March, and it is down 3.64%. And I also still have about 3,003 of cash available. It was barely affected by the market sell down due to the war. And the 2 new counters that I've added in is Nike and OCBC. After I add in Nike and OCBC, the market continued their sell down, and you can see that Nike have dropped another 9% from my purchase price, and OCBC is down 5%. And the JP Morgan, which is the bank stock which is barely hit by the Ukraine war, have dropped more than 12%. Currently, I do not have any plans to actually average in any of this counter, but I'm also looking at any other stocks that is an opportunity for me to invest now. Let's talk about why I add in Nike and OCBC. Nike, without much introduction, I think most people were aware that what Nike do. They are sportswear, sports shoes company, and you can see the t-shirt I'm wearing is also a Nike t-shirt. Now let's look at their financial numbers for their Q2 where they presented in last year, November. Their Q3 result will be out in end of March. Actually, they have been affected badly by the supply chain disruption and due to the COVID, and also the factory in Vietnam has shut down due to the COVID period. But let's look at their revenue for end 13 November 2021. Actually, there's not much changes compared to 13 November 2020. Practically means that they don't really have growth for their revenue. 1% to me, I don't consider that as really a growth. But one thing I like about Nike is their gross margin. You can look at the gross margin is more than 40%. This means that their profit margin can be very high for them just selling t-shirts, sportswear, and shoes. So this is one thing I like about Nike on that. Profit margin is very high. And next, let's look at what is the risk or something that we need to be concerned about on Nike. Nike is a global brand and the product is sold globally. And let's look at how is their performance in the various parts of the world. US will still be their dominant place where they contribute the most, and the sales for US are up by 12% based on year-on-year comparison. But one of the concerns is Greater China, especially China per se. Their revenue have dropped by 20%. So this is one thing we need to take note of that. But however, let's look at percentage perspective. The revenue for China contribute to their total revenue is around 20%. So the China market itself will have a 20% impact on Nike. However, more than 40% of the market is still from North America. And we can see Asia Pacific and Latin America also have a drop. It's about 8%. And also the weightage for the Latin America and Asia Pacific region is slightly lesser, about 15%. So the key concern of Nike on their growth side, we have to look at what is the impact for China when they announce their third quarter result coming towards end of March. Nike had mentioned that they are a growth company. They are constantly looking for growth, but they are also a dividend paying company. And how is their dividend? I take this data from Seeking Alpha. You can look at the dividend growth rate for 3 years, 5 years, 10 years. Like for 10 years, 13.22% CAGR. 5 years, 11.27%. 3 years, 11.36%. So what does 13% means growth in dividend? It means that every 5 to 6 years, the dividend double. Imagine you invest in Nike for 12 years, your dividend have doubled twice. That is what we mean by 13% in growth in dividends. However, when I invest in US company, I'm not looking at dividend, I'm not looking at the share price appreciation. As the dividend we collected is subjected to 30% withholding tax. And although we look at Nike, the dividend growth rate is so high, but the share price will move even faster. Thus, actually, their dividend yield based on current market price is only around 1%. And in less of 30% withdrawing tax, actually, a dividend yield is maybe only around 0.7%. With this type of dividend growth, it indirectly will mean that their share price will also able to grow equally fast or maybe faster. And let's compare Nike share price with S&P 500. This data is extracted directly from Nike website, where I pull out the past 10-year performance of Nike against SPY, which is S&P 500. You can see that Nike actually have outperformed the SPY over the 10 years period by about 1.5 times. You can see the total return for Nike shares is 462% over the past 10 years. But S&P 500 only achieved 295%. This is one of the stocks that actually have outperformed the S&P 500 over the long term. But however, past 1 year and this year, Nike share price was not really performing. As of 8th of March, you can see Nike have down 21% compared to SPX, which is S&P 500, is down about 11%. So Nike have dropped almost double compared to S&P 500. And let's look at their 1 year performance. And we can see that Nike have went through a good run, and after that, it actually crashed all the way down about 21%. Compared to SPY for the past 1 year, it's only down 3.4%. On a long time horizon, Nike actually has outperformed S&P 500. But in the short term, you can see that Nike actually have underperformed by a lot compared to S&P 500. Does it mean that it's an opportunity for you to accumulate Nike at this juncture? And this is a chart just to show you that over the 5-year period, you can see that Nike actually had achieved 127% return compared to S&P 500 that only achieved of 79. The recent drop of Nike is pretty drastic. Is there any growth potential in Nike going forward? Just selling sportswear. Last year, December, Nike have acquired RTFKT. This is a digital company able to help Nike go into the metaverse. What does it mean? That means you can practically buy a digital Nike products online. And with that, actually, we look at the other way around, well, the profit margin will be even higher for a digital product compared to Nike need to manufacture a physical product and sell to you. And Nike, the brand, is already selling by itself. And how Nike going to further increase our profit margin is, we have seen that Foot Locker, the share price has plunged most in the past 40 years due to Nike pullback. Nike is something like cutting off the middleman. That means you go to Foot Locker, you may not able to buy Nike apparel or shoe in the future, or you can get less and less Nike product there. And when you want to buy Nike products, you need to go to Nike store, and you need to go to Nike store online. It becomes on a digitalized basis, and this may further increase their margin as it cut off the middleman side. And because Nike is a brand by itself and he got many loyal followers, and thus they are not worried to cut off the middleman, and you just need to go to their platform to buy the products. So this is one of the plus point of looking at Nike, where you may see that their profit margin can be even further enhanced going forward. However, the risk of Nike is on a supply chain issue, as currently the COVID is still not fully over yet, and we may still see some supply chain issue in affecting Nike products being able to manufacture and deliver to the market. The second stock I add to the portfolio is the Singapore bank stocks, is OCBC Bank. On the US side, I have the JP Morgan. So on Singapore, I decided to add OCBC as one of the 10 stocks that I plan to build for the Singapore portfolio. And OCBC have announced their FY 2021 financial results sometime in February. And from here, you can see that OCBC actually, you can say, is really out of the wood from the COVID. Their profit have managed to come back to the pre-COVID level. The pandemic is still not over yet, but they have already managed to come back. And from here, you can see that practically OCBC got two main twin engines of growing. One is on the banking business, and the other one is a wealth management and insurance business, and all are growing on a year-on-year basis. Here's a breakdown of the various sector performance. You can see that the wealth management side actually is getting stronger and stronger, and this is what I like about OCBC. As when you invest in a bank, we are looking at two sides of income. One is the interest income, and one is the non-interest income. And the non-interest income usually comes from the wealth management and the insurance side and the fee side of income. So this is their net interest income. Their net interest margin is flat, it's practically flat. We know that interest rate is going to increase. Interest rate will increase, will no doubt give the banks more revenues, but that doesn't mean it will translate to more profit. So ultimately, we want to look at the margin they can make by that. So you can see the net interest margin for the bank actually is pretty flat for the past 5 quarters. It's over around 1.5%. So we shall see when the interest rate increase, would the net interest margin increase for the bank or it still stay the same? Another part I'm more interested to look at is on the non-interest side income for the banks. And this includes the insurance, the wealth management, the trading income, and the fees and commissions. It has been growing year on year. Compared to FY 2020, it has continued to go up and become stronger and stronger. Let's look at the breakdown. First, you can see the wealth management income actually have rose by more than 11%, and their AUM have grown higher year on year and quarter on quarter, which is a good news for the bank. And growing AUM means that indirectly you have more and more income. OCBC have managed to restore back to the dividend before COVID-19, which is the 53-cent dividend. As FY 2020, we know that MAS have asked the bank to cap their dividends, but FY 2021, the cap have been removed, and OCBC has managed able to restore back their dividend. And we can see that their payout ratio is almost the same, although their result is 47% and 49%. So their payout ratio don't really change much by maintaining the same dividend. So this is another thing I want to look at is if the dividend able to restore back, but if the payout ratio increased drastically, then this is something I will not be comfortable with. And we can see that before COVID-19, OCBC have been increasing their dividend, although they have increased their payout ratio, but the payout ratio is still on a pretty low range, where I think they got more room to grow if they want to continue to increase dividend payout, which I think it is possible for them. This is the share price for OCBC over the past 5 years. OCBC actually go through a roller coaster ride where the share price hit $14 and then it start to tumble down. And due to COVID, it have even at one time go below $7. And recently, he have tried to retest $14 again, but it failed and the war have started and OCBC now actually have dropped quite a fair bit, and the price now have looked attractive for me to start a small position on OCBC. Let's look at the peer comparison between the three banks. We use OCBC as a datum. You can see UOB have underperformed OCBC by 1.6%. DBS have outperformed OCBC by 0.7%. Actually, practically, you can see that their performance for the three bank year to date, the change is not that drastic. And you look at the 10-year time frame, OCBC have underperformed the DBS and UOB over a 10-year time horizon. But do take note, this is talking only about price performance. It doesn't include dividend payout. Actually, OCBC was a lagger performance during the past 1 year compared with the other two banks. However, why I still prefer to buy OCBC compared to the rest, one thing is because of the position sizing. To me, ultimately, all the banks will move in the same direction over the long haul, and they are a dividend paying counter. They will constantly pay dividend. But of the price itself, for my portfolio, it started as a small portfolio. Thus, to buy the UOB and DBS Bank, it will be a bit overstretched for my portfolio. Thus, I chose OCBC to kickstart on that. And OCBC have a slightly lower payout ratio compared with the other two banks, which also means that they got more room to increase their dividend if they just to match the other two bank payout ratios. So just to recap, this is currently my stock portfolio. We have 4 Singapore stocks. Of that, 3 are REITs, 1 is the banks, and I have 4 US stocks, Costco, JP Morgan, Microsoft, and Nike. I'll constantly find opportunity to add stocks that I think that is good quality, will able to help the portfolio to grow over time. The target will be 10 US stocks and 10 Singapore stocks. And until the portfolio grow to 50,000, then I may make some adjustment and maybe add in Hong Kong or China market. Now let's look at my unit trust portfolio. Currently, you can see my unit trust portfolio. All the 5 funds are down. With the one that down the most is the Aberdeen Technology, which is down about 18%, followed by China, which is down about 13%, and followed by a global fund 10%. Why this global fund is down 10%? As it is called a global quality growth fund. Means that they will buy good growth company. And good growth company will definitely include those tech companies like Apple, like Microsoft, like Google, with some of these tech stocks actually have dropped quite a fair bit lately during the market sell down. And the whole market sentiment is negative and the VIX index is very high. So you can see that actually the portfolio down is about 10%. And this portfolio is, everyone will do a dollar cost averaging of $2,000 in. And I may plan to do a mid-month top up due to current volatility of market and due to the market have been in a correction mode, which to me may be an opportunity to buy some fundamentally good unit trust and also stocks. Let's look at the chart, performance chart of this 5 funds. Year to date, all the 5 funds are down in double-digit territory, and you can see this down 24% year to date, while the best performance of the 5 fund is down already 12%. As I mentioned before, this is a very high-risk portfolio, which also means it's a very volatile portfolio. The standard deviation is more than 15%, which means that 2/3 of time, the portfolio can swing 15% up or 15% down. And when it comes to correction mode or when it comes to market downturn mode, the standard deviation will definitely expand further. But if you are looking at a longer time horizon and doing dollar cost averaging, ultimately you may see some result over time. And we shall see how this portfolio performs over a longer time horizon. And that's all I have to share with you today. And if you find that this video have benefited you, do remember to like and share, and also leave your comment below to let me know what you think. Lastly, do remember to subscribe and press the notification button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.